To end the day, we have a fireside chat on the buy side of things. Please welcome Jim Grosdanis, Managing Partner of Sprott Resource Lending, for a buy-side fireside chat with Matt.
How you doing, Jim?
Hey, Matt. How are you?
Good, not bad. Have a seat.
Good, thanks.
Right.
Could have been me.
Right, so we're going to talk about the market and depressing things that are going on out there. So Jim, why don't you introduce yourself to everyone? Tell them what you do.
Sure. Managing partner for a private fund. We started about 12 years ago, my partners and I, at a Sprott. It's all institutional money. Put about $3 billion to work, 80-odd deals since 2010. And then, prior to that, I was with Dundee and so been around the mining space for a while, got in the height back in 2010, saw the lows and saw kind of the flat line for a while, and now here we are.
Here we are.
Yeah.
Hey, well, look, there's people from buy side, sell side. Yeah. Everyone's here today. Lots of people sending questions in as well. I'm going to throw a few at you, and Joanne may throw a few your way as well. So, obviously, quite a complicated market at the moment. Hard to read. Yeah. It always is, but particularly hard to read at the moment. Your investment thesis was what, now is, and what will it be?
Yeah, that's a tough one. Well, let me, I think there was some comments earlier about gold and why investors might like it better than some of the other projects, and I think this kind of comes into the thesis a bit of many of the people here. Internally, my partners and I like to say that the non-gold projects are infrastructure projects with a mine attached to it, and then the gold ones are obviously part of the thesis. I think for a lot of exploration and developers are all the majors and intermediates, they're a melting ice cube. Their NAV decreases every day. So eventually they're going to need I think the last two people here were Dan and Treasury Metals. They're going to need those projects. So there will be value in those projects eventually, whether it's not in 2 years or 5, it'll be in 5 or something. So that's part of the thesis that we operate under is that gold will always catch a bid, there'll always be value there if you believe in the macro that it's a currency. And then on the other projects, call it the base metals and the others, the thesis is more along the lines is, can this thing work? Will it make money? And how long is the mine life? Because all those things do come into play, and the CapEx and everything else that goes along that are, you just don't see a lot of junior developers in it because the CapEx is massive. It's an infrastructure project. So if it's not an easy project to be done, it may never get built.
Right.
That's the thesis.
And I definitely want to get into that because as an investor, you want some of those clues and cues that we think the same thing, right? You're doing it on the basis of lending money. We're doing it on the basis of investing money in good projects, which will hopefully accrete over time. But I want to talk about something I mentioned when I was talking Treasury Metals, which was the fact that right now, when companies are trying to raise capital, by the time the paperwork is done, the terms are out of whack with what the position the company finds itself in. I mean, so you guys do you have to move a little bit quicker, or do you not mind?
We don't mind. We do go up and down the capital stack, but generally stay at the top and let the equity take more of that risk. So I don't. For ourselves, we have a bit of, when we talk about the paperwork and things moving all the time, we have because we're at the top of the capital stack, we tend to be a little more patient and have a larger tolerance for error or,
So you're good. How's the company feel?
Sorry, how's the company feel?
Yeah.
Well,
because it's just got a bit more expensive for them, right?
Yeah, but if their NPVs are 500 million and their IRRs are 40%, then taking another 5 or 10% off, it's it is what it is. Like that's the thing. It's the price of the market that's what it is. And if you can survive to fight another day, a year from now or whatever, you put your project on hold if you can, and you got to make that decision. It's so hard for me to. Everything's so situational based that I can't generalize.
Right. Okay. So let's say your company says, right, markets are tough. It's cost me a little bit more, but it's what I do with the money that's the important thing, dear investor. Please believe me, it's true. If they say the same thing to you or your organization, you're looking at different components. Right?
Yeah. So when we're making an investment decision, it is what if they can't move the project forward, because we don't want to be owners. That's not our business. Can they raise money in the capital?
Definitely not loan to own.
No. We've had to take one property on. Didn't want to. It was a small one. Every other one has been able to solve its own problems through M&A. And part of the work, at Sprott, like we see a lot of companies in, we know what is saleable, who might want to M&A it, and that's not our, so our business is not to be an owner. Our business is to make sure that we're not an owner. So part of our diligence is like, who will want to own this company? And we spend some time on that, and how the quality of the resources that are there. So if things do hit a rough patch, that they'll be able to tap the market or be able to tap a partner to help them get to the goal line or do a refi.
Is it easier being where you sit in the stack, in the sense that a whole bunch of people have done diligence before and have money at risk before you do? Or, I mean, how do you view it? Yeah,
for us, we are either at the PFS and beyond or the DFS. Permits are imminent. I would say the range of quality of work done on the resource and reserve statements is massive. So while they might be at that DFS stage, I think we would look at it and go, it's not quite a DFS.
That's
it's
really
still
interesting.
It's still economic, but it's not necessarily what the company is purporting. But I think the market has gotten smarter over the years, at least since the last 12 years. I think they're a lot smarter, and they see through that. I actually do think that they see through that, call it that promotional side.
You reckon?
Yeah.
Come on.
Well, maybe I'm an optimist. I don't know.
I spoke to a fund manager, I guess it was the end of last year, and he said, I've got 35 DFSs that I've looked at in the last quarter. Yeah. I think 5 of them I believe. That's right?
Yeah, but it's just validating what I say is that I think most people see through.
No, that's an industry guy. Your market for you is who?
Oh, the market for me, well, it is the industry guy, like the
right. Okay.
But my investors have no idea.
Right.
Their pension plans, endowments, they would have no idea.
They rely on you.
They rely on us, and we look at it like an equity PM, and we go, it's not. But
what's that ratio? What percentage is it?
I would go with? I would say 50-50.
Wow.
But again, you have to say, is it 50? Like, what is the tolerance that we're talking about? Is it like, 25%? Is it 10% on the grade? Is it on the throughput? What part is it? Like, I like to call executives, they're optimists. They're not necessarily liars, they're optimists. They're putting their best foot forward.
That's the new word, optimist, guys.
Yeah.
Take note.
They are, and they're trying to build a business, and we get it. Like, they're, so they put their best foot forward. But in there, I think a lot of these things add up to, whether it's the recoveries, the dilution, the throughput, and then you can get into the capital side.